it's just so good to see that. Like they were working, swimming in the same like direction. Like, yeah, it was just cool to see.
Measuring instead of from seed to Series A, from seed to death would be the more interesting stat, because it's not just that founders have been delaying kicking the can down the road. Heaps of them have gone back to be focused on getting cash flow positive and actually going, you know what, I'm not going to raise. I'm just going to build this like we did in the old days.
Yeah.
They invested 44 million in a minority stake in 2018. They have done some follow-ons. It doesn't say exactly how much they've done, but that stake is now worth 800 million.
So it actually seems a bit unfair that Canva's being called out for a clause that seems to be standard, if that is true.
We talk a lot about that 21 vintage and with hindsight how clear it is, but when you're in it, the ability to know that you're in that part of the cycle and to control your emotions and behave appropriately when you're in that part of the cycle, like that's the talent. And it is bloody hard to do.
Everyone in this room is now dumber for having listened to it. I award you no points, and may God have mercy on your soul. Good afternoon.
Hey, gents, how are we?
Hey, lads.
It's been so busy that it feels like a long time since we've done one of these. I know it's only been a week.
It does. It's been insanely busy since we got back.
Happy new deal launch day.
Yeah, got it out live this morning with the syndicate and lots of questions coming back and lots of inquiries, which is awesome.
I'm really excited for this one. When I go through the memo, A, we put a lot of effort into it. B, we went, I think, a bit deeper than anyone else. So I think we've covered our bases, but time will tell.
Yeah, absolutely. But looking forward to getting on the phones and chatting to the investors and getting their take on it.
And what have you been up to, Jack?
Lots of admin stuff since getting back from London. A lot of stuff like closing off a lot of the investment docs for our last deal, and actually been jumping on a few calls today with investors that are committed to our latest deals. A lot of admin stuff.
Better you than me.
Yeah. All we, no way.
Could you imagine if I was in charge of...
We need to get him a shirt that says that. How was the farm?
No, really good. Mainly because I had to get back to Brisbane on Tuesday for my normal day at the family office. And while I was gone, my brother-in-law and my wife teamed up and they just achieved unbelievable greatness. They replaced the floor in the shower. They painted the barn doors. They fixed path lights. Like it just going to drop them off and bugger off more often, I think.
You're more productive when you're not around.
Yeah. And no, it was really good. Haven't had a chance to get out there. So good to get out. And on the Kindy app, you get these parent apps and it tells you, and they had questions today. And one of the questions was, when are you the most happy? And my son, Jack, said, when I'm playing with dad at the farm.
Oh, how good is that?
And that's enough for you just to give up like all work, any material possessions, to say, right, buddy, you and me, I'm just going to spend time with you 24/7.
Yeah, that's a lifetime achievement award in itself.
He doesn't articulate that at home. Normally it's no, go away, a lot of screaming, but it's good to know deep down.
Oh, that is bloody awesome.
And you're at the slightly older stage, Aaron, and your son had quite a tumble on the bike.
Yeah, so the boys been out at the pump track around the corner and things have escalated pretty quick. So they were both sending it over a pretty jump, and Cruz went a little bit too hard and landed right on his side and took out a whole heap of skin off his arm, and he's busted his leg. He's on crutches, limping around like an old man, and he's making all the old man sound effects as he goes to move. So it's pretty funny to watch.
And I'll edit this, Jack. This isn't the episode.
Nah.
Oh, come on, what? You can't leave that hanging.
When do we want to? Yeah. All right. Yeah. Whatever you want to do, Don.
Mate, I merely just edit this podcast. It's up to you.
Easy. Whenever you guys reckon.
I think we do it now.
All right.
What news do you have to share, Jack?
Expecting my first baby in December, so baby boy.
If there was ever a time to use the new function in Riverside that's given me a whole lot of different things like drum rolls, that's what I should have done before the announcement. I missed the opportunity. Well, Jack, how good, eh? How good.
So bloody good, Jack. Jack Jr. on his way.
It is often good and nowhere near as problematic as I often bitch and moan about.
Yeah, just ignore everything Don and I complain about. It's life's work. It's amazing.
Yeah.
Nah, well done. And when's so due later in the year?
Yeah, early December. It's looking like got a bit of time. Right. Yeah.
Get your maternity leave in.
Yeah.
Oh, it's so exciting, Jack.
Well, let's get into it. We had a pitch call this week from somebody who had actually listened to the podcast, which is, I always then go, oh, you got to be careful then because I keep forgetting people listen to this thing.
It's nice they listened and still wanted to do the pitch call.
Yes. He said on it, in your last episode, you said that you only look for companies that can get to 100 million in revenue. And I'm not sure that we've modeled that. And I think just to clarify, I don't know of many businesses that have gotten there all that quickly. The question becomes is, do we believe it's possible? Do we believe that there's the conditions, the product, the customers, the total addressable market, all of those different things, that it's possible to build a business of that scale? Not, are you going to get there next year? It's just the reality of some businesses. It's not possible to even contemplate that size of business. I just wanted to clarify that.
Yeah, Don, just to add my 2 cents there. I really appreciated that the founder was upfront and transparent, that they weren't forecasting to get to 100 mil. There's nothing worse than looking at a pitch deck and in 5 years, it just magically reaches 100 mil. But to clarify what we meant, that the business model allows it to reach $100 million. And that just means that the dynamics allow you to. And there are 2 things there, like TAM, like the market's big enough to reach that, and then the actual dynamics of the business model. Any software company should be able to reach that just because it's the scalability side of things. Like the business model allows that. This isn't a service business where it's one-to-one. Like this is one-to-many.
Absolutely.
Yeah. Could rather than necessarily will. Like it's just that in the context of what we were talking about in that episode, it was distinguishing from other types of businesses. We were specifically identifying high growth venture backable businesses.
And I didn't have it in the notes, but I'm reminded that Harry Stebbings put out a post this week, and it just of a whole lot of unicorns, how long it took them to get to that unicorn status. And there were some really well-known companies that take a long time. But at the time of investment, even though it took that long, it was still a possibility. The business model still allowed it to achieve it. So I just wanted to clarify that. So let's get into some news. Telstra Ventures, as a name, is no more.
Yeah, now known as Titanium Ventures, which makes a ton of sense because Telstra Ventures always grappled with this perception that you had to have some relevance to Telstra in order to receive investment, whereas it was actually very distinct. It operated autonomously, that you didn't have to have a particular drawback to Telstra in any way or line back in benefit otherwise. So it's great to see, and shout out to them. They've been going for a while now, and they've invested in 99 companies, 12 of which have IPO'd. There's 17 unicorns in there. So yeah, that's just on 17%. 42 liquidity events, 1.3 billion in funds under management, and they've returned almost $1 billion back to investors. So bloody good performance.
Amazing. That's great.
That makes me wonder, did they really grapple with the name Telstra Ventures? Like they got quality deals. Like, come on, that's a good track record.
It's a good point, Jack. Maybe it's just us externals that never raise money off them that see that, and it's actually just a demeanor. It's not actually a real thing.
Yeah, well, their line seems to be clear towards unicorns.
Yeah. Yep.
That was a...
Can we press one of the...
Yeah, don't hang up on me just because of my joke about... Okay. Yeah, you mean this one, Jack, as in... But I think there's a whole lot of firms in our ecosystem that are really moving up. And Skalata came out in an article by Tess Bennett. Skalata was the most active VC with 13 investments in the January to May period of this year.
Yeah, so well done to them, followed by Blackbird with 10 investments, Investable at 8, Breakthrough Vic with 7, Airtree with 6, and then a sprinkling down to, what is that, the top 10, Alice Anderson Fund and Main Sequence Ventures both at 3 each at the bottom of that table.
Is this where we say, well, we did 3 as well?
Yeah, so I wrote it in the show notes. We did 3 in the same period.
Including our small follow-on allocation.
Jack, no one needs to know quantum. We're just talking a number of deals.
Who asked you? Was it an investment?
Yes. May have been a tiny pro rata follow-on.
But I think the point of the article that shows that actually 2024, January to May, is actually ahead of 2023 for capital deployed, even though the deals are still down. And we're going to get to some Pitchbook data later. I think this data actually shows a better picture than what Pitchbook might be picking up. But yeah, great to see. When I have a look at that, though, because of our vision for Tribe and the way we want to operate and the amount of time we want to spend with founders, there's no way I can see us ever growing to be at the top of a list like this.
No, totally. With the amount of time that we give to portfolio companies and the nature of our thesis, we're not going to be the biggest investor by volume of deals in any quarter or year.
I think one of the other things, the earlier you go, the higher volume your number of deals are going to be. And that's why you see main sequence more towards the bottom, Skalata at the top, because they play a different series.
Yeah, it makes sense. So Skalata, I believe, focus on pre-seed. So you'd expect to see a higher volume, like deal cadence.
The other thing from this article for me, the data they quoted was a total of 1.7 billion having been invested in Aussie startups in the first 5 months of 2024. And just for comparison, so UK market in 23 deployed 21 billion pounds, about 42 Aussie. So even on a per capita basis, given their population's roughly 3.5 times ours, they're still miles ahead, even on per capita in the UK. And we'll get into the data when we go through the Pitchbook stuff. I'm really looking forward to that part.
And look, whilst it wasn't the type of business that we would invest in, and nor is it tech, the GYG float, I think just captured a lot of investors just because of I think it was partly the scale. It was one of the few big floats that have happened on the ASX in recent times, but also the sheer amount of negativity of people. Like some people have even called it a Ponzi scheme.
That's been around a lot on LinkedIn.
Yeah, but yeah, Guzman y Gomez IPO went public at $2.2 billion valuation, reached a $3 billion valuation on its opening day. At the top of the list of shareholders that did really well was TDM Growth Partners. It's fair to say we have a bit of a following of TDM, and I've got some news to share with you a little bit later. I'm working on a little project, so watch this space. But anyway, they invested 44 million in a minority stake in 2018. They have done some follow-ons. It doesn't say exactly how much they've done, but that stake is now worth 800 million on paper.
Wow.
Good.
And given we've adopted the 4-pillar approach from TDM and really like the way they go about analyzing investments, supporting investments, and how giving they are with their content, sharing their investment thesi, I don't know. Yeah, I think it's really great to see a great outcome for them.
Yeah, really great to see. It's good to see the TDM guys getting a win, and also obviously the founders and everyone else involved. It's a great outcome. There's been a lot of talk on socials too that is this the turn of IPOs again, and is this kind of a return to the IPO market being positive? And so it's not just all negative shit stirring and throwing at Guzman and Gomez.
Yeah, well, some of the negativity. So I think it's like it was 76 times pro forma next year's earnings, and the pro forma earnings took a few things out, and people were screaming blue murder that this was a Ponzi scheme or ridiculous. The way I look at it is that investors are really making a bet on whether this single license entity, so Domino's, Burger King, all of those entities, they're broken up regionally. They got sold off ages ago. So if you look at Domino's, I think the Australian entity, of which Jack Cowan is like a major shareholder, I think its market cap's about 3 billion. The US entity, I think the market cap was around about 15 billion US. So convert that into Aussie. Then they've got other entities. So when you add up someone like a Domino's by itself, you're $30+ billion of market cap. And so if you pay $2.2 billion today, the bet that's being made is that these people can execute their way into creating a $30 or $40 billion company over the next 10 years. And if that happens, 2.2 billion is pretty good value. 10, 15, 20 times your money is a venture return. Now, if you don't believe that they can execute, don't buy the stock. But I think a business that's growing at this rate, that's producing the revenues that it's producing, the people jumping up and down saying it's accounting fraud and a Ponzi scheme, for fuck's sake, don't look at early stage investing, because if you're pissed about these metrics, you should see the shit that we invest in. That'll knock your socks off. You're not sure where to go to from there.
No.
Well, what? So true.
It's horses for courses, and they're not trying to put anything other than who they are. Now, there was an article that came out by Sarah Thompson, Kanika Sood, and Emma Report that says Guzman and Gomez has a history of missing forecast, documents show. So they found some documents from 2008 that was forecasting certain numbers 5 years later for 23. Now, they missed that forecast by 38 stores. So instead of having 248 stores, it looks like they've got 210. But like 5 years ago, to have gotten within a postcode of their forecasts, which they're what, 15% off with that level of growth? That's a bloody good result.
Yeah, I was going to say, missing forecast. Welcome to our world.
Yeah, like it's like fast-growing business that has taken on capital misses forecast. So
The only thing faster than their growth is how fast they change their forecasts.
yeah. Oh, because we were talking with a couple of founders on the mission, and they were talking about their financial modeling. And the problem is I've become a bit old and jaded. My view is I'm just trying to work out whether you're a nutcase or not. I don't actually believe if it's too low, where's the ambition? If it's too great, where's the psychologist? And it's trying to find that middle ground. It's not really trying to hold too much to believe that in 5 years from now, you can possibly know what the future holds.
Yeah, it's a good point. The early stage we play at, it's like an assessment of the rationality of the thinking that went into the forecast more so than the numbers themselves.
Now, IPOs can make investors rich and founders rich, but the wealth of the founders is really determined by how much they've had to give away on the journey to getting to IPO. And there was an interesting chart that put together data from Jason Lemkin and Peter Walker of Carter, and it's SaaS founder ownership at IPO. And I thought that this was quite interesting, mainly because the two Aussies, the Atlassian lads, were just top of the pops. They managed to list with about 75% ownership, and the nearest entity is Zoom Info at 55%, then Klaviyo at 50%. But if you have a look at the average, it's the founding team has about 22% by the time it gets public.
Yeah, it's just phenomenal seeing Atlassian as this massive outlier on that bell curve. And then the other thing I picked up from this one is it's reasonably consistent. Like that average, that zone where most of the companies sit, that's been consistent for 10 years sitting around there. It's not like there's a trend curve that we can see in there.
And when I took my little empire to the ASX public back whenever it was, 14, I owned 56% of it.
Above average.
Above average. The only point I would make is that if you fuck a few things up and the shares become worthless, it doesn't matter whether you own 100% or 10%. But yes, old man reminisces of days gone by. I'm not sure what the GYG, I think the GYG founders are sub 20%, which sort of makes sense given their business model and then the sheer amount of capital that has to go into setting up those things. It's a lot different, I would have thought, to a software entity.
Yeah.
Now, part of the rationale for listing quite often is being able to use listed script to be able to attract people, but you've got to be a bit careful. So whilst the GYG team have done really well, did you see that Cettire, who's been under a lot of pressure from short sellers, a lot of pressure with people calling their business model a bit flaky, not liking their earnings? The problem is that seems to have turned out to be true because they had to do a profit downgrade and a revision, and the shares dropped 50% in one trading day. Now, that ordinarily isn't a problem, but the CFO, the poor fellow, was vested options last August. Now, what happens is, from a tax point of view, it's the vesting date that the capital gain is locked in. So the vesting price was $1.21, and at the time of the vesting, the trading shares were $4.79. I think the tax bill out of that, according to this article by Jonathan Shapiro, was 4.2 million. And so normally what happens with these people is they don't really hold, they sell the shares, they do the stuff. But now that the shares have dropped 50%, the options are worthless, but he'll still have the tax bill.
Yeah, it's painful enough having to come up with the tax on a paper gain, but to have a real loss, I really feel sorry for this situation. And there's a lot of talk about how this regulation will change, and it seems to be always more, the rumors are more on the aggressive side rather than on the better side. So
I don't know why the regulation can't just have it at the time of the liquidity event itself.
Exactly. Yep.
The fact that options done at the vesting stage, now a lot of people assume they're in the clear, the share price might go up and down, but there'll at least be some value out of the options. But unfortunately, the market has not rewarded them for whatever they put out. And I have a feeling maybe the CEO could come to his rescue, because the CEO, Dean Mintz, has been a little bit smarter. He's managed to sell $330 million worth. And the last share sale before this was $127 million in March. I'd love to be a fly on the wall in some of the conversations with shareholders that are now nursing a stock that is down, I think, close to 80%, with the CEO having cashed out that amount. But that's above my pay grade, and I probably shouldn't cast aspersions.
Yeah, it's hard to know the timings and inner workings of all that. But yeah, it wouldn't be the most pleasant thing for people to be experiencing. I forgot to put it in the show notes, but there's it's not a rumor, but it was published in the UK how they're considering changing the way that carry is treated for VC and PE funds, where instead of carry for the fund managers being treated as a capital gains tax event, it'll be treated as a revenue event.
Oh, God.
Yeah, so that's a significant change. And if the UK is considering it, then I imagine Aussie government won't be far behind.
Well, given what they're looking to do with self-managed super funds.
Yeah. And this is the watch out for founders, right? Like the tax implications of these things like options pools and ESOP programs and everything else. You have to consider these things, but you also can't not do it because of these things. It's just this, and this is where the government, I think, could just clean it up and simplify it.
Now, before going public, private companies issue often shares and options. And there was an article by Nick Bonyhady from the AFR talking about Canva's equity scheme, similar to what came out with OpenAI, that Canva can actually claw back departing employees' share rights if they publicly criticize Canva. And he points out this was a similar structure to the one that the OpenAI boss, Sam Altman, apologized for. I think the words he used was he was embarrassed. Now, these are the kinds of things that I don't believe are black and white. People that are against this say that this stops, whistleblowers, and when there are bona fide big problems, this becomes a chain around people's neck that stops dissent and stifling competition, is what this article says. But at the same time, how does a company use its equity and protect its position? So I don't have a very good answer. If someone was a bad leaver and just a dickhead and was just unreasonably causing havoc, I would absolutely want to deliver consequence to them. But maybe I'm just old school. But at the same time, if there is some bad stuff that is going on inside there that needs to find its way out, then you need to have that path as well where people aren't unfairly penalized. So I don't think it's an easy one.
No, I agree. I have seen this there was a shareholders agreement recently I saw, and it had, in the bad leaver clause, it actually talked about negative public comments post leaving as being one of the triggers for the bad leaver clause to claw back. And there was an ESOP one similar. It had actually specifically mentioned, I can't remember how it worded it, but it was publicly criticizing the company was essentially what I was getting at. So I have seen this a couple of times recently, put in different legal docs.
Yeah, so I saw this article posted on LinkedIn, and one of the comments was that this clause is actually listed in the standardized docs. So they've actually just copied across, like it's listed on Airtree or whoever else listed it. So it actually seems a bit unfair that Canva's being called out for a clause that seems to be standard, if that is true.
Yeah, I think there was one point which was, and I can't remember where it was, but there was one point it was part of NDA agreements, which again, the nature of an NDA agreement is non-disclosure. Yeah, I think your point is right, Jack. Like there's certain things that are already common in legal docs and agreements and legal practices being touched on here. But yeah, I understand the sentiment of if you're a true whistleblower and you're going to go out and say something truly damaging to the company that's of a whistleblowing nature, what's going to be the impact on the share price anyway?
Although it's just interesting that OpenAI, or at least Altman, has made representations saying that he would get rid of them. But at the early stage, I think there has to be some reasonable mechanisms to ensure that reasonable behaviours occur without stifling the other rights. But
even what they reference as well about the Canva contracts having a broad non-disparagement clause for departing staff, like that's pretty standard. A non-disparagement clause as part of a termination is pretty stock standard. So yeah, I think there's a lot of things here being conflated into one pool.
Why don't we just head this off the pass and just publicly disparage each other now, and then we don't have to worry about.
Yeah. It's like Gary V's deleveraging. Let's just air all our shit. The airing of grievances. We'll have Festivus on air each week.
We'd never get to the episode. Now, before you get to the listed status and also being able to dish out sort of equity and the long-term incentives, you tend to have needed to have gotten to Series A level. Not always. There are some companies that don't need to raise and don't need VC and all of that. But what we saw in some data out by Peter Walker is the infographic stuck in seed round quickstand. No matter the industry, many seed stage startups can't raise their Series A. And what this chart shows is consumer, SaaS, fintech, health tech, hardware, and biotech across the board from 2020. It's down in terms of the percentage of companies that are getting from seed to Series A. And so in 2020, as an example, 30% of consumer companies that got to the seed stage on the Carta platform then went on to a Series A, but that's now dropped to 14%. In SaaS, it was 37, that's now dropped to 12%. In FinTech, 41, that's now dropped to 18%. Health tech, 34, now to 13%. Hardware, 32, down to 17%, and biotech was at 40, and it's now down to 9%. And so just across the board, we see that continuing to fall.
Yeah, and this has been consistent with what we've been seeing and talking about, where particularly that era. So this is when these years that are quoted in the chart is when those companies last raised their seed round. So companies that raised seed in 21 or 22 at the peak of the cycle, and that's the first half of 22, basically most of them, the very vast majority, haven't gone on to do their Series A yet. So they've been kicking the can down the road, which it's reflected in all the other data we're seeing across the investment stats as well.
Which I don't blame a founder if they have the ability to kick the can down the road, especially if the multiples weren't founder friendly. So I'm starting to think like maybe Peter Walker is actually just a really good marketer and there's not much value in these graphs that he puts out, because seed to Series A, it should really be seed to graveyard as a measurement. Like seed to Series A doesn't give you much value to take away, because we know that multiples were investor friendly, therefore you'd want to kick the can down the road. But that doesn't mean that there aren't really good businesses that are still evolving and maturing.
I think your first comment, Peter Walker being a good marketer, absolutely.
Yeah, he's an absolute, he posts all these graphs, and you see him, you'll stop, give it 30 seconds. That's interesting, but it's actually not much value, but it's interesting.
That's the whole point of this podcast. It's like
interesting, but not much value. That's our tagline.
Yeah. Like again, I'm trying to, what are you expecting?
And I love that it comes like, Dom, we talk about gaming the algorithm. It's always from Peter's account. He's head of insights. It never comes from Carter's own LinkedIn. So there's a bit of a takeaway here for founders. Like they're getting cut through and it's not traditional.
Look, I used to like track Tribe's account versus our competitors, but I don't even bother anymore, because it just every now and then when there's a bit of motivation, we'll forward and repost stuff from the Tribe account, just so that if someone ends up on the account, it looks like we've got some bit of life. But all of our portfolio and the founders that I engage with, if I see that all they're doing is from their main company account, it's just a waste of time. It's got to be the personal account. You've got to be doing founder-led content. You've got to be developing that brand. Like we're going to get to Tenacious and Sarah, but just Sarah announcing their raise, she got like 1,000 engagement, hundreds of reposts. If they had done that just from the Tenacious account, okay, they might have got a bit of stuff, but nowhere near that level of traction.
Yeah, 100%.
Well, I'm sorry these charts don't entertain you enough, Jack. So why don't we...
Wait, before we go, I just had a quick look at the original post. It got circa 900 likes, 185 comments, and 68 reposts. Like that, what a wizard marketing channel they've got through Peter's account.
Yeah. Well, we're talking about it.
Yeah.
And I think it's a little bit on that theme, Jack, but Ben from Employment Hero, Ben Thompson, was in an article by Dan Van Boom of Capital Brief, and he put it out there that if Series F raise from last October, the $263 million raise, might be their very last. He's quoted as saying, "We don't foresee doing another capital raise unless there was some opportunity to acquire something and we needed more capital at. As it stands today, we have more cash than we're ever likely to burn."
Good position to be in. But going back, this was Jack's point before, like measuring instead of from seed to Series A, from seed to death would be the more interesting stat, because it's not just that founders have been delaying kicking the can down the road. Heaps of them have gone back to be focused on getting cash flow positive and actually going, you know what, I'm not going to raise. I'm just going to build this like we did in the old days.
You have a business that washes its own face, like far out.
We make that joke, and Tribe does not yet wash its own face. I'm fully cognizant of that.
Well, given the budgets, we don't even have it for the soap to wash our own face. But
Yeah. I'm going to say Don hasn't showered in a couple of years. Poor bugger.
that's why I look so old. If I just had a nightly skincare regime, I wouldn't be accused of looking like I'm 60. But now some of the competitors have been throwing a bit of shade at Employment Hero in the article, rippling the latest entry that comes, I think, from the US. The founder, Conrad, told Forbes Australia that Employment Hero has very much underinvested on the product and R&D side, while ANZ Managing Director Matt Loop knocked the local unicorn for not offering device management, identity management, or single sign-off features. So they're having a crack at Employment Hero at the feature level. Ben Thompson hit back with saying Australia is one of the most complex payroll environments in the world, and that American companies entering the market are likely to encounter significant difficulties navigating it. So it certainly is a hot and busy space, but I think Employment Hero has created such a brand. I think these big US entities might find it a little bit challenging.
I just love how well the company's doing, and the ANZ managing director's like, oh, you guys don't even offer this feature and this feature. It's like they've been successful regardless of those small features being missing. And it's much easier to add a tiny feature than it is to build a business that they've built.
Yeah, and particularly when you have scale, like to copy other people's features is so easy when you have the resources.
Yeah. And look, Ben himself with that fracas with Host Plus, clearly this is a driven CEO that's got a lot of energy that is ready for a fight.
Yeah, and another thing, Don, that I really liked, like when all that happened with Host Plus, to see the chair of the board believe it's Adrian Bunter, like he was standing by Ben's side on LinkedIn the whole time. That was just so cool to see the CEO and the chair of the board.
I don't think Adrian's the chair, but he is a non-exec director.
So, yeah,
the point still stands.
Yeah, and it's just so good to see that. Like they were working, swimming in the same direction. Like, yeah, it was just cool to see.
Yeah. And not just seeing it publicly, but Don, I recall you saying you were on a couple of calls with Adrian in that period. Like he was just passionate. Like
No, Adrian, I'm on the board with Adrian he is an awesome investor to have in your corner. And if stuff is not the way it needs to be, he's coming out swinging. He's got the energy. He's in the trenches with you. Yes, he's an investor, but shit, he's got the founder energy as well.
I think that goes back to the role of a director in an early stage business. Like it's more than what you expect at a governance level for a more mature business. Like it's more hands-on, and a lot of founders don't actually like the idea of getting together a board. But like after hearing Addy speak in London, like it's an accountability thing, get it early, but it needs to be done right.
I've had late night calls with Adrian. I've had weekend calls. He's with companies that he's in. He's put up personal assets to help get things through. Like, yeah, the investors that you want on there. So I highly recommend connecting in with Adrian. But look, we'll see what happens with Employment Hero. We always go for the Aussie, hoping to get Ben on the podcast at some point. Now, what Ben also said in a panel interview last week is he put forward Superfund money into the early stage ecosystem to help get it primed and cranking. And so this article from Nick Bonahady as well. Ben Thompson, the chief executive of $2 billion HR software company Employment Hero, said big superannuation funds should have to dedicate 1% of their cash to startups. This would unlock about 15 billion worth of investable capital for Australian startups, but also attract startups to the country. So that was his idea.
Well, in the UK, this has been talked about a lot, and there was the Mansion House Compact. It had a weird name, but in the UK, there were 9 VC funds super funds that committed to putting 5% of their funds under management into VC. It is happening around the world. It'd be great to see it here locally. That's a lot of capital that would be flowing into the space.
In that same panel, Richard Joffe of Honey Insurance, which raised 108 million in April, said that had he have raised the money in Australia, his company would have been valued at about half of what it was valued at. The Australian venture capital was good for funding rounds up to about 20 million, said Mr. Joffe, and international funds became interested around 75 million. That then leaves a gap in our market, which could cruel the prospects of companies. So the word have to as in mandated, as in required. I always get a little bit nervous probably on those things, because whilst the intent is good, if someone has to do something and then there's a time constraint around it, or they've just got to make decisions for the sake of the decision, you just tend to see some malinvestment. If there was a way of incentivizing super funds in order to do it and ensuring that it did spread, because for high growth, high performing companies like Employment Hero, there's no shortage of cash. They can pull cash from so many different places. But that seed to Series A of getting the future Employment Hero up and running, but that's also the riskiest. And if it was easy, everyone would do it.
It's a good point. Yeah, if done correctly, potentially super powerful, but the track record of government mandating things like these, or worse, government managing things like these, you could see a whole heap of capital hitting the markets at once. It needs to be deployed within a certain time frame, regardless of cycle in the market and everything else.
But it's good to see Ben at that level, given where his company's at, advocating for smaller companies and trying to drive the conversation positively. So now, I think touching on a number of the topics that we've discussed today, there's some data out by Pitchbook, which was the Pitchbook report into the Australian and New Zealand ecosystem. It was the market overview. I've put a few slides in the show notes here. I think it tells the story that we broadly already know. COVID was up, it's really down. I think it's more negative than that earlier article that's starting to show some green shoots. But yeah, it does show just how difficult VC is at the moment. And early stage emerging VC ain't a walk in the park.
Yeah, I was surprised looking at these charts how much of a cliff it has actually dropped off so far, like year to date 24. Like that, it's significant. And
I like the VC exit data for this year to date. They had to round it to 0.
I mean, our deal cadence is up, and yes, Jack, look, one or two of them might be tiny rounding errors, but like I'm feeling we're seeing good quality deal flow, but obviously, like very clearly, very few deals actually getting done by comparison to previous years.
So if it's interesting, going back to that earlier data set, if the likes of Skalata and Blackbird and all of those big ones are still doing their cadence of deals, then it must mean the periphery ecosystem of angel groups, direct angels, all of that jazz, that must be down.
Yeah, but even that data we talked about before, in the top 10, the bottom, 4 or 5 were doing 3 to 5 deals so far, first 5 months of the year. Like they're not big numbers, but yeah, there must be a big void somewhere in the market.
Last year in London, some of the discussions were later stage funding. There was a big gap in the later stage. So pre-seed to pre-series A, we're still getting the funding, but companies that it's been given a follow-on funding to try and prove out despite missing forecasts, they didn't get another shot. So that's seemed to be there's this later stage gap.
Yeah, if you're a new story that hasn't disappointed and like you're just having a first bite of the cherry, you're in a different world to people that are, trust me, this time I've got it right.
Yeah, 100%. Just
stop laughing, Jack.
So, you need that tattooed. Like, trust me, next quarter.
Like we say, we're not expecting perfection in terms of the numbers. We do expect process, honesty, hard work. And so I try and separate the inputs from the outputs. And if you believe that people are doing the best they can and seeking to innovate and pivot and change and become systemic and all of those things, then if the numbers aren't working out, it's easy to stay in the trenches. If you don't believe that bit and the numbers aren't working out, life becomes a little harder, that's all.
100%. That's our ethos, right? Like we, even with our own performance, like we can't guarantee outcomes. We can't guarantee outcomes for investors, but we commit to our processes, we commit to our behaviors, and it's the best we can do. And similar with founders, like we measure by the behaviors. Markets will shift, things will happen.
I did find one of the charts interesting. It's the private capital dry powder. And it just shows post-COVID, the dry powder sitting on the sidelines still continues to increase. And that from the 2021, 2022 era, where they raised a whole lot of capital, there's still a lot of that capital to deploy. So a lot of funds, especially early stage funds, will invest 40 to 50% of their fund in their first round, and then they'll retain 50 to 60% for their follow-on. That's the model that often runs out. And so obviously the fact that there's so much dry powder just shows that the follow-on capital is probably still sitting there. because it just keeps growing each year, and they call it the overhang of the amount raised but yet to be deployed.
Yeah. So for listeners at home, one of the charts is VC deal activity, which shows both deal value and deal count. And for first quarter 24, 97 deals in total, which if you multiply that out by, assuming it's at the same rate, and you've got to take into account there, Australia shuts down from pretty much December right through January, particularly on the investment scene, or even Melbourne Cup last year right through.
Melbourne Cup to Australia Day.
Yeah.
I love that. That cracks me up. And it's so true.
So painful. Do not try and do a raise after Melbourne Cup. You can finish raises and get some stuff done, but fuck, this country is awful.
But then the problem is, Don, then you get to the European summer. So it's like, all right, there's another month or two.
No, seriously. Mid-February to like May is sweet. And then don't forget Japan came on this year. How many of our LPs and shareholders, it's like, oh, sorry, I can't do that. I'm in Japan skiing.
The number of times I got an update on the snow in Japan when we had deals going out, it was just insane. But you're right, we get 2 sprints in the year to put stuff in front of investors. So yeah, so looking at these numbers, maybe it's just the fact it's first quarter, not many deals get done coming out of Christmas into early Feb, and we might see a spike second quarter. Actually, it's interesting because the next chart is quarter by quarter, and it does show. So typically, Q1 quiet, Q2, 3, even 4 up. So there is a bit of a pattern there consistently.
Just hold on one second. End of financial year is an absolute nightmare. So I'm having to multitask while I do this. Yeah, totally agree. So whilst we're talking about difficulty in VC market and just how hard it is to raise, a lot of founders, I don't think, realize that VCs themselves and need to raise and spend a lot of time raising. And Tenacious Ventures announced that they had done a first close on their next fund. They managed to close at 18 million. Sarah did a post, again, from her personal account. That's where the activity comes. But we've had Sarah on the podcast, and I'm going to do a re-release of that because I just think that their thesis in ag, I think how they approach it is really great. And we're also co-investors in Swarm Farm, and we like the cut of their jib. But look, in this environment, to get that away is a really great effort.
Yeah, great outcome. We're really excited for the team there. We see a lot of deals referred from them at different times too. But really, Sarah's approach, like she produces a lot of content, really high value. Jack, to your point before, her content's actually valuable, has insights in it. So it's great to see them get this away. Bloody good outcome.
So in an article by Nick Bonyhady, the Sydney-based fund's new investors include Reserve Bank Australia board member Carol Schwartz, Tesla chair Robin Denholm, via her Wollholm Capital Group, and Maddock Ventures, which invests for Rupert Murdoch's daughter Prudence and her entrepreneur husband. Talk about an amazing new set of investors coming on. Well done, team.
Yeah, pretty good pedigree.
In the article by Nick, it says Tenacious closed its first fund of 35 million in 2021 when the technology market was hot.
Like, that just demonstrates the state we are in, doesn't it? Like, it's crazy.
Yeah.
Bloody tough market.
So the article goes on to say that Tenacious had originally hoped for a $70 million fund, but is now aiming for a $50 million fund. Yeah, so as you say, Jack, it just demonstrates, I think it's in the name, they've stayed tenacious. Imagine raising 35 million, not really knowing that 2021 was 2021, and then you set your sights on 70 million, and they set their sights on that in 2022, and they've just closed now in 2024. Haven't given up, kept at it. And the economics of small funds is
fucked.
yeah, that's the word for it. You're not washing your face on 18 mil.
No, so you've got to love it. You are cash flowing this baby through, and they obviously have an absolute passion for this, because if you didn't think that you could continue to raise in the future, you wouldn't be playing this game, because 8 mil is probably enough just to cover compliance costs. But that's why they're targeting 50 mil, and I hope they absolutely get there as quickly as possible.
That little convo just saying, do you guys remember the scene in The Office where the guy goes, I wish someone would tell you it's the good old days before you're out of the good old days? And it reminded me of that convo we were having in London, Don, around, we talk a lot about that 21 vintage and with hindsight how clear it is, but when you're in it, the ability to know that you're in that part of the cycle and to control your emotions and behave appropriately when you're in that part of the cycle, like that's the talent. and it is bloody hard to do.
Well, let's beat around the bush. No. Let's not beat around the bush. It wasn't genius. It was luck that Tribe started late 2021 and therefore got the majority of its stuff into 2022 when things have normalized.
Oh, especially as it like early in our foundation era, like the number of factors that would have gone into decision making differently, like far out. We'd have made so many mistakes.
I was talking with one founder this week. I think the reality of valuations are coming through. And I was just explaining with this current deal that we're doing at the moment, like 200 and something % growth, a order book that if they capitalize has a straight line through to 10 mil ARR in very short period of time. And it's at a single digit low multiple. Like it's just the 2021 times are gone. Yeah. And people have to build real businesses and get investment at prices that investors can actually make real returns at.
And the podcast. That's pretty much it.
Yeah. So well done to the entire team there. Now the team has actually expanded. Sarah started it with Matthew Pryor. However, the team has recently expanded. Vela Georgiev has joined Sarah and Matthew, making a predominant female investment decision team. And another really great female founder who's also been on the podcast, similar to Sarah, is Catherine McConnell of Brighte. And Catherine announced about a week ago, exciting times at Brighte. We've secured a $195 million green debt raise, positioning us even more strongly for future growth. This is our 5th issuance, and the funding allows us to continue our journey towards making sustainable equipment more affordable and accessible by everyone. And that post put up an article by Kate Burgess of Capital Brief. And in the article, it talks about how Brighte, which is majority owned by Atlassian co-founder Mike Cannon-Brookes, raised asset-backed financing, which then lends to households to pay for the installation of solar and energy-efficient appliances such as electric hot water and induction cooktops. The company's most recent financial report shows that it generated revenue of $32.9 million for the year ended June 23. What a great story, and just keeps going from strength to strength. That debt financing aspect is now in the billions.
Yeah, it's bloody good. Really impressed with Catherine, like when she was on the podcast, and she was also part of the Luke and Ears startup series. Like just a bloody solid founder that's getting it done.
Brighte last raised equity in 2020 when it tapped existing shareholders for about 100 million, of which Cannon-Brookes himself tipped in 78 million. So he's certainly putting his money where his mouth is in terms of that whole green space.
Yeah, far out.
Now, speaking of 100 million, an entity that was not known to me, this is an article from Tess Bennett from the AFR. CAMS, a family-owned software business backed by Ellison Capital, has been acquired by Riskonnect, an American risk and compliance technology company owned by private equity TA Associates. Now, this company was founded in 1996 as a management consulting firm. CAMS then transitioned into a technology company 16 years ago and makes risks and compliance software for the likes of Adelaide Airport, City of Brisbane, and the Royal Air Force in the United Kingdom. The deal, which contained a small equity component, is worth north of 100 million US, delivering a substantial payday. Mr. Collins, so the co-founder Joe Collins and the chairman of CAMS, was previously executive of the South Australian Council and grew the business without taking an external funding round for the first 23 years. He used a thing called cash flow to fund the growth.
Don just air quoted that.
to grow the subscription software business, which now generates close to 40 million in annual revenue. What a great story.
Yeah, bloody cracker. Adelaide based.
You first pointed this out to us, Jack.
Yeah, I love that it's out of Adelaide. How good. Like a sleeper no one even appreciates, and such a good exit.
I love the transition from consulting firm into actually creating a product and then scaling it.
I do believe they actually kept the accounting firm going. Like it was in parallel to this business, I believe. So Tom, who works in the same co-working space. So yeah, it's just such a good story for South Australia. And by all reports, it seems like there's going to be a recycling of capital now going back into the local ecosystem here. So it's great to see.
Yeah, great story. And that's where sometimes we talk about founder problem fit. Like, why is the founder uniquely placed to understand this problem? And coming from the risk consulting, clearly saw a problem with the technology available, took the cash flow from the consulting firm, put it into the software, and then built an amazing company using recycled cash. I've just got a knock at the door here of Matilda. Have a look at this. So my daughter has just turned up with a motorcycle helmet on. Where are you going, darling?
I want my motorbike to go a bit more fast.
You want your motorbike to go a bit more faster. Okay. Daddy's just in the middle of a call. Daddy will finish this, and then I will zoop up your motorbike so it goes faster. All right, off you go.
Hey, Don, if you want to run and do it, feel free to do it.
Can you just give me 2 seconds? Can
Yeah,
you just sit
go
there?
for it.
Yeah.
Just hold on.
Matilda would get along well with Mia.
Yeah?
Yeah, we're taking the dirt bike out this weekend. We haven't had it out in a while. We're going to go out to Ipswich. There's a track out there.
Yeah.
Mia's just, can it go faster?
All right, I'm back. We'll see what... And then she asked for a jump. It's like, I can't build you a jump at the moment, darling.
Oh, she's got to hang out with Mia. In fact, the boys now, yeah, fuck. This is awesome.
Yeah, no, it is. Dad needs to get his own motorbike to cruise around with them, but
This
I'll
is what I
join
was
him on
just
the
saying.
quad.
The lawnmower, it's not fast enough.
No, I'll get the quad out. Where did we go up to before I...
I think we're about to segue into Roger Federer.
Yeah, so to maybe just, I guess, finish the news bit. This was less news, more a bit of a post that I saw posted by Aram Attar, and he had put together a bit of Roger Federer's commencement speech at a university he did recently. And what Roger was talking about is that trying to go for perfection is actually a little bit daft. Now, it would be fair to say he was one of the greatest tennis players in the world. I'll just read this bit of his speech. Perfection is impossible. In the 1,526 singles matches I played in my career, I won almost 80% of those matches. That's amazing. Now, I have a question for you. What percentage of points do you think I won in those matches? Only 54%. In other words, even top-ranked tennis players win barely more than half of the points they play. When you lose every second point on average, you learn not to dwell on every shot. You teach yourself to think, okay, I double faulted. It's only a point. Okay, I came to the net and it got past again. It's only a point. Even a great shot, an overhead backhand smash that ends on ESPN's top 10 playlist, that too is just one small point. And here's why I'm telling you this. When you're playing a point, it has to be the most important thing in the world, and it is. But when it's behind you, it's behind you. This mindset is crucial because it frees you to fully commit to the next point and the next point after that with intensity, clarity, and focus. You want to become a master of overcoming hard moments. That is, to me, the sign of a champion. The best in the world are not there because they win every point. It's because they lose again and have learned how to deal with it. You accept it, cry it out if you need to, and force a smile.
I love that.
Bloody good advice.
So true.
Like if that's not good advice for the startup ecosystem, I don't know what is.
But that point about winning he won 54% of points to win 80% of the matches. And I think for founders who are, or anyone, you're losing and you look at where you think you need to be to succeed and it looks like this massive leap, but maybe it's only a few percentage points difference of outcome that statistically gets you massively ahead.
Yeah, or even on the micro scale, the day-to-day, it seems like it's just battle after battle, but when you zoom out on a bigger time frame, it's actually up and to the right.
And it's not just surviving the bad times. This too shall pass. His point about even when you have the smashing good shot or you land the ace, the next point is all that matters. Like you've got to go into that next point with total focus and wanting to just nail that next point.
And you need to have resilience partly because you got to deal with idiot VCs. And I
100%.
saw this little post from Kevin Jurovic. Things VCs say versus what they actually mean.
This was so good.
Yep. What VCs say, keep us in the loop for future rounds. What VCs mean, never talk to me again. We invest at inception. What VCs actually mean is get to 100K ARR, then come and talk to me. Has VC in their LinkedIn bio is really the analyst.
Guilty.
I was an operator. What it actually means is I interviewed at a startup once in 1999.
Oh my God, I laugh. Oh, I don't want to say it, but fuck, I know so many people. That's so true.
Let me know how I can be helpful. Actually means please never ask me to ever be helpful. Patagonia is okay. Actually means I have 6 vests in every color and can't wait for the full collection to drop. And then the final one is that's an interesting opportunity. What it actually means is this opportunity is in fact not interesting at all. Everyone in this room is now dumber for having listened to it. I award you no points, and may God have mercy on your soul. Now, Jack, that actually comes from a movie called Happy Gilmore, one of the...
I was so happy you won.
You have seen that one.
Oh,
I know that,
yes.
I know that Adam Sandler grates on many people, but that scene... So anyway, I would like to think we are not any of those.
We're definitely guilty of a few.
I've been pulled up on my use of the word interesting.
But genuinely, we are good people.
I believe so.
Keep telling yourself that, boss.
Jack knows best. Well, let's get into the charts. Still haven't found sound effect. I found this chart. So what this is, I thought this was interesting. Someone actually did a study into like people that are happy and people that are unhappy. So most people's life satisfaction matches their personality traits. So they actually went to get a correlation of people's life satisfaction versus their personality traits. And so if you have a look at this chart, it's split left and right. On the left is blue, on the right is red. And what it's trying to do is people that are satisfied with life and people that are unsatisfied with life. And then it looks at the correlation of personality traits. And so some of the things that correlate highly to life satisfaction are personality traits like self-improvement, loyalty, liking to visit new places, a belief that you have a duty to one's family, easily apologize when wrong, risk-taking. Yeah, you can just go through. I'll put this in the show notes. Trust in others, ability to act as a leader, starts tasks in the right way. It's just got these coefficient correlations that just rate really highly with people that have high life satisfaction. On the opposite side, the people that have low life satisfaction postpone decisions, get bored, let others take advantage, make enemies. A few of these, I must admit, maybe I'm not as satisfied with life as I think I might be. Postponing decisions is a bit of a killer. Stops working if things become too hard. Feelings get hurt easily. Prefer to be alone. Easily distracted. They're all the things that correlate with low life satisfaction, according to this study. Anyway, that's an interesting chart.
I think, yeah. Oh, look, it makes sense to me. Just going through all those.
I think this is a study that's proved what anybody probably already knows. Now, here's a chart. So this is the net position of NVIDIA insiders, so shareholders, employees, board of directors, that kind of stuff, the net position of their purchases and sales. And so this chart is just matching the sales. And what's interesting is that insiders at NVIDIA are selling their shares at a faster pace that's happened in a long period of time. As NVIDIA keeps getting higher and higher, insiders are just selling significantly.
Do you think it's just realization of profits now that they surpassed Microsoft and hit phenomenal all-time highs?
Could be, but if you thought that it could just continue up to the right and hold on for a little bit. Having said that, once you get to a certain point, from a risk management point of view, I mean, take the CFO of Cettire earlier. I bet you he's wondering, why didn't I just sell a few before it shit itself?
Yeah.
Now, this next chart is the total return percentage for 2024. So this goes back to January 2024, and the S&P 500 is up, but the small cap ETF, right? So I think the small cap ETF is the 2,000 stocks below the S&P 500. That's actually down. It's really a tale of two markets. And I bet you with that S&P 500, I bet you it's 10 stocks that are powering the majority of its growth. And so there's really not a lot of breadth. And I think that's highlighted by the next chart, which is the short interest. We are at record low territories. Nobody is positioned for this market to fall.
Yeah, number of shares sold short and still outstanding. Yeah, okay. Wow.
It is just, so at the peak of 2014-15, it was close to 450 million sold short. We're now down at 90 million sold short. Now, short selling has a negative connotation, more the activist short selling, where people actively try and drive share price down. Then there's just standard risk management. People just need to hold some stuff short in their portfolio in order to offset other positions. But we're just seeing all of that short at record lows. And so nobody is thinking that this market's going down. This next chart is the Bitcoin in US dollars versus the NASDAQ 100 since 2020. And as you can see, it's a pretty good correlation. Bitcoin really is just another tech stock when you look at that correlation. Now, what's interesting is that since the last few months, Bitcoin and the NASDAQ have diverged. So the NASDAQ keeps going up, Bitcoin is flattening out. So the question is Bitcoin going to jump to match the NASDAQ and the correlation stays true? Or is the NASDAQ going to fall and Bitcoin is just front running that fall?
Yeah, super interesting. Bitcoin's down 15,000 Aussie since first week of June. So what's that in 3 weeks?
Yeah. So is it front running the broader market? Who knows? Now, this next chart, I think we've been banging on for a while. I keep saying when the whole world thinks something's going to happen, in my life's experience, the opposite tends to happen. And for a lot of this year, people are like, well, interest rate fall by the end of the year, economy tanking by the end of the year. One of our portfolio company founders and I have a bet. He believes that there's going to be an interest rate cut. I believe there's going to be a raise. And if I'm right, he pays for lunch. If he's right, I pay for lunch. I'm already sending recommendations of restaurants because there's no way I'm losing this bet. And
I'm curious now which founder this is.
I'll tell you after. But have a look at this chart, right? The 2024 inflation index, the price stats in points, is tracking where we were in 2022, right? 22 was a big inflation year, and it is well above the 10-year average. Now, we can argue modern monetary theory aspects as to whether interest rates do have such a direct effect on inflation, a whole lot of different things. What we do know is our Reserve Bank thinks they do, our government thinks they do, and I don't see why we're going to get a cut. I see why we're going to get raises.
Yeah, that's what the data's showing.
Which is someone that's got a bit of debt related to property. That makes me, I should go and tell Matilda not to get too used to that motorbike in case we've got to start selling assets. Which one of you idiots didn't tell me to share my screen?
I'm not even looking. I'm just looking in the doc.
Just for the YouTube audience, I'll just scroll quickly. There's that one. That's if you're satisfied in life, not satisfied. There's the NVIDIA one. There's the short interest. There's Bitcoin. There's the inflation one. Okay. This is a little bit random, but this is global fertility rates. And why this is relevant is that our economic capitalistic model sort of relies on fertility, which is why Elon Musk seems to be trying to single-handedly repopulate the earth. But you can just see across the globe, like South Korea has the biggest. Like it was in 1960, the fertility rate was close to 7 per family. It's dropped now to 0.8. China was 5. It's now 1.2. Brazil was near 7. It's now 2. Yeah, people have learned that too many kids is just not fun.
Have you learned that, Don?
One of the challenges becomes is if you've got lower birth rate and you've got less new workers coming through the system, it's going to be interesting to see how this chart falls out. What this chart showing is the US spending by the government on national defense in terms of consumption expenditures and gross investment, along with their interest payments. And for the first time, they are spending more on interest repayments on their government debt than they are defense. And Luke Roman is the post that I saw. It says, Ferguson's law states that any great power that spends more on debt service, i.e. interest payments on the national debt, than on defense will not stay great for very long. And then he goes and lists out all of these other empires that have fallen because they let their debt levels get too great and then they couldn't keep up. So random, but we'll see. Now, these aren't really charts, but I just felt that this segment could get evolved a little bit. So this is a little meme. Jesus walks into a bar. 12 waters, please. Winks at the disciples. First year startup founder, Taylor Swift. 10 years later, Dog the Bounty.
It's about 2 years in VC world.
Dog the Bounty Hunter. That was a great show. Great show. Unfortunately, he's no longer with us. And then I found a meme that won't offend anyone.
It's an empty blank square for the listeners. Oh.
On that note,
I did have a little chuckle when the meme you shared about the lady walking to a glass window repeatedly and you had some founder analogy and you copped a bit of criticism because it offended someone. I'm like, geez, we have got a little precious.
oh, Jack, it says Jack's computer stopped recording. Only their recording stopped due to hardware limitations. Have you run out of disk space?
It's showing his little dot.
Is it? Okay. All right. Fingers crossed. All right. What are we looking forward to?
Looking forward to. Well, this weekend, I was saying to Jack before, we're taking the dirt bike out. They're going to get the kids out on the dirt bike again. And then we're going to play some disc golf in Brizzy.
Oh, sweet.
Yeah, Marin's brother is right into it. So every time we go into Germany, we play disc golf, and it's become a bit addictive. What about you, Don?
I'm looking forward to catching up. Got a bit of stuff to do on the Renault. A lot of repayment to my wonderful wife. Going to send her away, and I'm going to take the kids.
No, yeah.
So looking forward to that. And we're going to be hitting the phones with this deal. It's going to be a big one. All right. Good day.
Thanks, boys.
See you guys.